contestants actually ended up growing their money by using the Reliance Simply Save app. They had their money at their fingertips, but at the same time, it was also invested. Interesting, isn't it?
Pointing to a flat opening on Wall Street as hopes of the Dow hitting 20,000 fade. The dollar slips to a two-week low against the yen as treasury yields fall. Here at home, the Sensex gains over 150 points. The Nifty manages to reclaim 8,100 on December expiry day. The retreat in the dollar cushions sentiment in emerging markets. LIC eating our learns plans to lap up stocks that are available for cheap, fresh money into equities is likely to surpass last year's investment. More tax was collected after the note ban, claims Finance Minister Arun Jaitley, with just one day to go for the December 30 deadline. The FM asserts that the impact of demonetization is not as bad as predicted. Also says the critical part of remonetization is behind us. Government plans a massive national outreach to be kicked off by an address from Prime Minister Narendra Modi on the New Year's Eve. Ministers will hold a series of rallies and mass contact events as well to defend demonetization in the days to come. Bad loans may still rise further, warns the Financial Stability Report put out by the RBI, citing elevated risks to the Indian economy. The report recommends tax reforms, including GST. Also says the note ban will boost efficiency and accountability in the banking system. And the tug-of-war between the Tatas and Cyrus Mistry continues as Tata's son sends a second legal notice to Cyrus Mistry, asking him to return all confidential documents in his possession. Seeks, in fact, an undertaking from Mistry that he has not shared any sensitive information of the Tatas with the Shahpurji partnership group. Hello there, good evening. You've joined us right here on Smart Markets. I'm Tanya Bharadwaj here in Mumbai, and joining me on the show is every evening for all the market stories. We'll chat with Ajay Sharma, who's right here in the studios, and Krishna Kumar is waiting by to walk us through all the national and political developments. But first, let's talk about what went down on trading floors today. The December F&O series for one ended on a pretty firm note, with the Nifty reclaiming 8,100, a one-week closing high for the Sensex as well. You have to say that short covering really came to the rescue. And of course, the other big factor has been the dollar weakness that we've seen overnight, where the greenback has faltered to a two-week low and actually continues to languish at that level in, of course, comparison to the yen. And that to some extent has helped emerging market currencies today find their feet. And of course, we got a good bounce thanks to that. All sectoral indices today saw good traction, barring pharma, but autos and metals did exceptionally well. Ajay, a sudden spurt of buying, if you look at that intraday chart at the fag end, really helping, lift the mood and spirit.
That's correct, Tanya. In fact, we were not getting any, helping hand from rest of Asia or even Europe for opening, but we were managing it on our own. But you did not, you should also observe that FIs, the DIs did not give it up on us. In fact, they were continuously buying in the last hour of trade in the last couple of days, and the same trend played out in today's session. The dip was being bought in the first hour of trade, and 8,100 got taken out. Most of the technical chartists were indicating that 800, 8,100, looked achievable on the charts, and that's exactly how the script played out, at least in the short term, because that oversold territory, a rebound from there, seems to be gathering much more steam. So almost 1,000 crore bought by DIs today, whereas FIs selling was small. But FIs were actually buying in index futures. So the internal of the market are not that weak. Advance decline ratio was heavily in favor of the advances. Participation in the broader markets were also very good. And stocks which are weak yesterday, the commodity stocks, Select Auto, and even Reliance Industries, the heavyweight, that tilted towards the positive side, as if dips were being bought in the large cap stocks. So that was today's market, looked okay. In fact, for the series, we've gained smartly in trade. Let's see how it goes. Tomorrow being the last day of this particular year, and the DIs have been in action probably. Let's see what levels we end the year on.
Okay, let's take a look at how, global cues though are shaping up. Remember, overnight you had, gains on Wall Street somewhat losing momentum. Right now though, the Dow is up about 40 odd points. Of course, those are just initial ticks coming in, but there you go. The Dow at 19,864. But the fact is that hopes are fading that we will actually see the Dow top 20,000 at least by the end of this year, which of course is just one more day to go. Remember, we talked about the weakness in the currency where the dollar has slipped to a 2-week low against the yen, even as treasury yields are falling. Ajay, if we were to drill it down to, what's led to this sudden loss of momentum, what would you say?
In fact, the wait is just getting longer for the 20,000 mark. However, it may be just a formality because we are practically there. But the wait is just getting longer and the volumes are low. So last couple of days, including today, one wouldn't read much into it. Perhaps next week is something we need to keep a watch on. Yesterday's sharp cut actually made a lot of people nervous because that was the biggest cut we saw in almost 10 days. And people are again raising their brows that probably a correction is coming. But, there's a very big, investor and practitioner of finance from Wharton School of Finance, Jeremy Singh. He says that, perhaps those who are waiting for a sharp dip may have to wait much longer because the sharp fall isn't coming in US markets. So focus got shifted because he's a very respected guy. Almost every other Wall Street fund manager has gone to, Wharton and hence studied under this guy, Jeremy Singh. He's also an investor, by the way. Yields actually coming down is a bit of a worry. Yesterday, remember, we were discussing how Eurozone yields are falling.
Yeah.
Today, the US yields are falling. That could make some amount of traders nervous globally. Let's see whether it's only a 1 or 2 day trend or it stabilizes. Dollar retreating is actually good for emerging markets. So it's trading off the highs it saw in the last 1 week at least.
Okay, let's chat about that then with two special guests joining in on the show. Gurraj Singh Sangha, who joins in, of course, on the phone line from New York. And we've also got Shyam Sundar Bhatt of Exide Life Insurance joining in. Gentlemen, both of you, thanks so much for taking time out for us. Gurraj, let's first talk about the mood that is in your part of the world, so close and yet so far, somewhat summarizes what traders perhaps are thinking about the Dow topping 20,000. A bit of a wobble coming yesterday. Are you reading too much into it?
Right. I think, historically, when the Dow's approached these big numbers, 5,000, 10,000, and now 20,000, it tends to move through those milestones relatively quickly, or there's this type of action where this back and forth where traders are anticipating a break, and when it doesn't come, they start reducing positions. The interesting thing this year is it happens to occur around the end of the year, and so although there's traders still largely anticipating a move past 20,000, probably into the Trump inauguration between now and then. But given it's year end, there's a large amount of rebalancing of portfolios that occurs in the last few days of the year, particularly pension funds who've seen a great benefit of the equity rally since the Trump election, have a need to rebalance their portfolios by selling stocks and buying bonds to meet their target ratios, and that's probably going to act as a cap on the market at least for the next day or two, and with 20,000 looking like a move waiting until 2017.
Gurraj, there's a point which we are probing last couple of days and would like your opinion on it too. The way S&P targets for 2017 are being upgraded across the board by strategists. In fact, the earning estimates for the next year are looking very rosy as well, including the broader market. High single-digit numbers being talked about for Russell 2000. If that is the case, and indeed that's the kind of earnings growth pans out in the next couple of quarters in US, what would happen to the emerging markets, the growth markets where most of the large allocators tend to go to chase growth?
Right. The emerging markets have certainly faced some difficulty given the dollar strength, and with the strategists have historically erred on being too bullish early on and have it to ratchet down their expectations as the year goes on. Having said that, the market still tends to move in anticipation, and so it's likely that there'll be further capital flows into U.S. markets, but also into emerging markets to reflect some essentially quality buying and prices that some strategists and portfolio managers feel are discounted. That said, I think that the dollar strength is likely to continue until the middle of the year, as I spoke about before, and that will probably act as somewhat of a cap on too much emerging market strength, which then will have that strength probably wait until the second half of the year.
All right, Gurraj, we'll let you go on that one. Thanks so much for talking to us right now. Let's shift focus and speak to a domestic money manager, Shyam Sundar Bhatt. He's the CIO of Exide Life Insurance, typically the long-term money. Shyam Sundar, good evening. Thanks a lot for your time. How are you analyzing the situation in the market right now? There was an all-round fear. We went to almost sub 7,900 mark, but then rebound. But at the same time, the upside seemed to be capped according to most of the strategy reports. How are you analyzing and also approaching the market right now?
The way we are looking at the scenario today is that clearly the outlook has to be much longer. So not just for the next 1 year, but from a 2 to 3 year perspective is what an investor should look at the market. And therefore we feel that the market right now and possibly in the next few months will give good opportunities for investors to phase out their investments and then lock themselves in to see good returns over the next 2 to 3 year period.
Okay, let's look further ahead and, Mr. Bhatt, talk about the year 2017. How do you see the year pan out in terms of the kind of returns that this market will give us? Because the fact is that 2016 in that regard has been pretty forgettable. Also, what can be said about the earnings rebound? Is that can also sort of kicked further down the road given the government's cash cleanup?
Frankly, 2016 was clearly a very, very eventful year, both on the domestic side and on the international side, where we've had several events, both here and globally. And while the markets have actually been flat now on a full year basis, and actually now for the second year running, the markets have actually digested all these events quite well, and I think that clearly deserves to be noted. As far as 2017 goes, clearly there will be, it will be, so to say, the year of two halves. We would have heard this before as well. But now more than ever, it does look like that would be the scenario, particularly in the next few months. As the remonetization happens and the economy comes back into where it left off a couple of months back. So clearly there will be this period of pain followed by the recovery subsequently. So I would say in terms of earnings growth per se, it will be clearly the second half of calendar 2017 which will see the earnings growth kick in, which could possibly look very high optically given that the next 6 months are likely to be quite depressed.
So, you're basically making a clear case that we should be bracing ourselves for, further downside from these levels. If that were to be the case, then what all is it that you will be buying, say over the next 6 months, if we do see a patch of weakness?
Right. So prior to that, what I'd like to mention is that just like what we've seen in the last 2 years, there's been a striking difference between what has happened to the Nifty and what has happened to individual stocks and sectors. So while earnings for the Nifty have been flattish and the Nifty itself has been flattish, clearly the earnings for some of these stocks have been very strong, and so have the capital gains or rallies in such stocks. 2017 clearly will not be much different from this. Again, possibly it will be even more stark in terms of differentiation between individual stock sectors and where the Nifty itself would be headed for. Within this, 2 or 3 sectors where we remain very positive. One is clearly the automobile sector, wherein we've seen, of course, initially the figures of the month for November have not really indicated the pain caused by the cash crunch. The month of December might show that the pain which didn't get reflected in November, and this might continue for a couple of more months. But our view is that clearly in the longer term the growth for this sector will continue to be very strong, and the stocks are poised to do quite well, at least some of them. Similarly, cement is another sector which currently has seen a sharp sell-off, particularly given the kind of volume dip and expected also because of the slowdown in real estate. But again, this is another sector which in the longer term could do very well. So we've utilized the correction to add to the cement stocks as well. And just I'd like to add the third sector, which is the consumer sector, both in terms of staples and durables. Again, another sector which wherein we have used the opportunity by the sharp fall